Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and I'm speaking today with Jordan Roy-Byrne, founder and editor of TheDailyGold. And Jordan, it's always great having you on the call just to get an update on how you're looking at the markets from a technical basis, from a fundamental basis, from an intermarket analysis basis. And I guess we need to start off with some of the price action that we're seeing on the charts as we get near the end of the month, near the end of the quarter. We're seeing the dollar and rates spike, but we're seeing gold, silver, the mining stocks all trekking lower. Let's start off with gold. When you look at gold today, it's dipped below the 1900 round psychological number, but also as a key support number on the longer term charts. What do you make of the price action in gold? Where are you seeing support and resistance?
Well, if we're looking at gold and silver, they've basically more or less been in a range since the middle of May. So for about 4 months, they've been in a range. I mean, gold has been, for those 4 months, basically trading from about 1915 or 1900 up to 2000. So now gold is breaking that range to the downside. So we're probably going to see at least, at a minimum, more selling because it's a technical breakdown. There's a significant amount of long-term moving average resistance in the mid 1800s. I think we've talked about it before, the 1830 to 1850 area. But if you look at this technical breakdown, I mean, there's a potential, you could say, okay, well, it's a $100 range. It broke below just above 1900. So, if I think about that and I look at a monthly chart, I could also see a move down to the low 1800s. So those are the levels I'm looking at for gold. And by the way, silver has been outperforming gold, or at least, performing less poorly than gold here recently. It hasn't broken down out of its range yet, but the same thing for silver in respect to there's been a range for the last 4 months. And for silver, it's mostly been from about 2250 to 2550. So I think that's way more likely than not going to break to the downside. If we think about the macro, yes, we're more in a inflation, not quite a stagflation environment yet, but there is inflation. And so in that kind of environment, silver is going to outperform gold. I mean, if we were going towards a recessionary type environment, a more deflationary type environment, which, maybe we'll be going to that at some point next year, that's a kind of environment where you'd see gold outperforming silver, but we're not there yet. So that explains why silver has been outperforming gold recently. But I do think we're going to see silver, break 22 or 2250 and follow gold lower.
Yeah, so both the metals breaking down below the ranges they've been in, and silver getting a little boost from the industrial component because we're at a slightly inflationary uptick the last few months, but still ultimately it's going to trend with gold lower. When you look at the silver stocks, though, or the gold stocks, they're really getting hammered. GDX and GDXJ today have started breaking below the lows that we saw in February and March, Jordan. So what do you make of this break to new lower lows for the year in the mining stocks?
Well, I mean, the price action has been really ugly for weeks. The miners did get, in terms of my breadth indicators, they did get, I would say, extremely oversold in August. And so it's taken a little time to work off that extreme oversold condition. I mean, coming into this week, my breadth indicator, just some of them were in the low 20s in terms of, percentages, because a lot of these indicators, they go from 0 to 100 basically. And so I like to see those indicators below 10%. When you're in a downtrend or a bear market, it's not just okay to see something at 20% or 25. Like, you need to be at 10% or really in single digits to know that the sector is really, really oversold. So that's something I've been talking to subscribers about in recent weeks. And so coming into the week, we weren't that oversold, but, I'm going to check that or get that updated today. I suspect we're probably around 10% right now in some of those indicators. I mean, there's many that I look at. And so, you have, obviously, looking at the charts, they're pretty ugly for the HUE, GDX, GDXJ. I mean, SILJ, that's been leading everything to the downside. So, I mean, as far as a support level, we were talking beforehand and looking at GDXJ, I see a lot of support, strong support around 27. I see GDXJ's at 32 right now. So that's kind of an ugly proposition where there's more downside. So I think, and by the way, that's pretty close to the October 22 lows. And so I think for GDX and GDXJ, that's where things could be headed over the weeks and months ahead. Now, granted, we could see another rally in between, where we are here and now, maybe for a month or so. GDXJ, there's a bit of support here at 32, but I think there's some support around 30. And so if, we get some more selling here and in the breadth indicators, you see single digits, that could tell you, well, we're extremely oversold now and the market's going to bounce, or at least, maybe it consolidates for a month or so. But ultimately, I think what I want to see to really get bullish again, I mean, the macro is really important. It's more important than the technicals. I know we can get to that, but looking at the technicals and just focusing on GDXJ, I would want to see, okay, this is at 27, 28, and you have breadth indicators at 5% or even below. Like when most of these breadth indicators are below 5%, like that's when you're going to see, at worst, a pretty good rally.
Yeah, so watching those breadth indicators for the low readings to kind of show that we're really oversold. But just one more technical question before we shift over the macro. We are getting near the end of the month, the end of the quarter this Friday. All of this happening as we head into month end is not really a great sign for the charts. But you were mentioning when you looked at the quarterly charts for the metals and even for the miners, they didn't look as bad as, let's say, the dailies, the weeklies. How are things looking on the longer duration charts like the monthlies or the quarterlies, in your opinion?
Well, yeah, I mean, looking at the quarterly chart for gold, yeah, I mean, it looks fine to me, but at the same time, gold could come down to 1800 and it would still look fine to me. And so it's not that far below where we are, but still, I would prefer to see it bottom, in that 1830 to 1850 range. The silver quarterly, I mean, you have tons of resistance at 25, 26, but, I'm just zooming out here looking at it as we're talking. It doesn't look that negative to me, but yeah, I mean, the monthlies do look uglier. And yeah, we're seeing, unfortunately, coming into the end of the month and the end of the quarter, the technicals were questionable in August and coming into this month. And so now we're seeing a lot of money they're cutting out. And, in a bearish market, you sometimes see that at the end of the month and the quarter. Like that's when you see some really heavy selling. And so I think some of that downside momentum will probably continue into the end of the year. But thinking about the macro, if that comes into bullish position, then, I wouldn't worry that much about lower prices.
So it sounds like for people listening that, yeah, we're getting beat up a little bit in the metals and the mining stocks in the shorter duration charts. But when you look at the longer term picture, it's still within the healthy range for it to still be in a larger bull market pattern. But we need the macro to shift. So let's talk macro. We've talked a lot in the past about needing to see the general markets roll over when you look at intermarket analysis. And when you look at the general markets, they've had a pretty good year, but even the last 2 months, they rolled over. And again, the dollar surging and the interest rate surging because of Fed policy is not really helping the general markets either. They've actually sold off a lot. Is that encouraging to you that the general markets are starting to pull back, or is it discouraging because precious metals are pulling back just as much?
Well, it really depends on how this thing plays out. I mean, with respect to the general market, I'm not sure if this is the start of a huge sell-off in a new bear market. I'm not sure if that's happening now or if that's going to, happen at some point next year. I mean, after, the market's going to get oversold, you'll probably see some kind of a rebound. But yes, I mean, repeating what I said about the big picture, I mean, I strongly believe in that with respect to, you're not going to see a new bull market in precious metals until you see the stock market roll over, lose its 40-month moving average, the economy goes into a recession, then the stock market's in a secular bear. Gold can bullish consolidate for another 2 years before that happens. I mean, hopefully it doesn't last that long. I'm not saying it's going to take another 2 years, but if the stock market, if you avoid a recession next year, gold can continue to have this huge super bullish base. I mean, just because it's super bullish, that doesn't mean it has to break out in the next 3 to 6 months. Just circling back again, it's all dependent on the economy going into recession and then the market losing its 40-month moving average. And with where we are here and now with the macro, the hope for precious metals is that this move in long-term bond yields, we've seen a breakout. the hope is that it continues to, to the upside. And at the same time, you get a steepening of the yield curve. It goes above zero to indicate a recession. It breaks something, you have a recession, and then the bond market completely turns and, the Fed has to cut rates. And at the same time, bond yields breaking out and moving higher. That's going to continue to pull the dollar higher at the same time. I mean, gold usually leads the dollar, but the point is we need that stuff to really continue. We need the higher bond yields, the dollar moving higher. That continues. You get the steepening of the curve. Something breaks, you get the recession. Then the Fed has to cut, and that's the trigger for a real bull market in precious metals. And so, but the problem is in this whole act that I'm talking about, we're just at the beginning part where yes, long-term bond yields have broken out. The dollar's moving up and gaining strength. That's what we have to watch for over the coming months. Is this going to break something in the economy? And at the same time, watching gold. How is gold performing against foreign currencies? How is gold performing against the stock market? Those are the types of things and indicators that at least I'm going to be watching over the weeks and months ahead to signal that we're really close to a bullish turn for gold. Because if you don't get a recession and bear market and the economy can just continue chugging along, throughout next year, you're not going to get a breakout in the gold price. And this sector it's really going to struggle. I mean, that's not my base case scenario, but it's important to outline that in the grand scheme of things.
Yeah, it's a solid point, and I think it's one that we've been looking for a while. We've talked about the steepening of the yield curve. We've talked about waiting for the recession. Most of the recession calls have been moved to next year from this year. Initially, they were for the middle of this year, but now they're the middle end of next year. We've seen that with the shifting expectations around where the Fed rate cuts would start coming in. That's another factor. But one other thing we've talked about, and I'd love to circle back on it, is you had mentioned a couple months back that we actually may see inflation increase before we see more of a deflationary period. And that's exactly what we've seen, Jordan, over the last couple months. It hasn't been a lot, but inflation has started ticking up 2 months in a row. It looks like the third month in a row here. And we're seeing energy. Look at oil. It's back up above 90 in the 93, 94 zone. So we are seeing inflation creep up. How does the inflation expectations tie into this? And what do you expect to happen if we finally see that kind of round off here towards the end of the year and then start heading back down again next year?
Yeah, it's a really good question. And I mean, the point that I'll make, I'm also looking at, energy is a late cycle leader. So energy really outperforming, oil doing well. You typically see that before, you see a bear market and a recession. And the other thing is oil moving up and energy prices moving up. If that continues, that also reinforces the move up in bond yields, because bond yields are basically, what is nominal growth? What is inflation? So if you have oil moving up off of the base, it's kind of had a base for a while. Oil's moving up off of that. Natural gas, I think, is breaking out or, might break out soon. That's also, puts inflationary pressure on everything. That keeps long-term inflation expectations up. So that reinforces the move higher in bond yields. But at the same time, we're seeing, I just pulled up copper. Copper technically looks terrible. We know what's happening to gold and silver. I mean, the dollar's obviously gaining a significant amount of strength. So, I think your question is, when or how are we going to see all these things shift? I think it really comes back to the yield curve. I mean, we have seen some steepening this week. There's still a little ways to go to see that get to zero and go above zero to indicate a recession. I mean, again, there's still some ways to go to get to that point. So I mean, as far as when things will shift, I mean, that's what we have to watch. And, at the same time, if we see gold really strengthening against the stock market, that's also kind of a recessionary indicator. So to me, those are the things that can really signal that you do have increasing risk of a recession, that's more imminent than later. But, the granddaddy of all these signals will be when we see bond yields peak and put in a violent reversal. When something breaks, then we're going to have this kind of quick bout of deflation, and then everybody's going to be rushing back into bonds. So, I mean, that's the major signal. But we're at the point where long-term bond yields just broke out last week. So there's I mean, I don't see that signal coming. It's not going to be something that happens in the next, 3, probably 6 months. I think it's going to take a little bit longer. So like I said before, like we're at the beginning stages of all this. Like that's what we'll have to watch for over the next couple months to see, are bond yields running? Are they going to break something? Because the curve steepen to above zero to indicate a recession. So I know it's kind of a roundabout, rambling answer, but that's how I'm seeing how things might play out here over the next 6 to 9 months.
Okay, Jordan. Well, we'll wrap it up there. So it sounds like in the short term, not really a pretty picture, really, for any markets right now, with the dollar and rates screaming higher. But when people widen their scope a little bit and look for some of those signals you just mentioned between the intermarket analysis and some of the signals from the bond yields and some of the signals that we see as we shift from inflation to deflation, something breaking in the economy, those are all things we're going to have to keep tabs on. Doesn't look like it's imminent, but it's something that is going to happen eventually. And until then, it's just going to be some rough sledding for investors. Thanks for coming on and sharing the technical levels you're watching in the stocks and the metals. And until next time, Jordan, always looking forward to our next conversation.
My pleasure.